mutual funds are used for a particular purpose. The pension fund is used for an entirely different purpose. And that is why the power of compounding has to be seen to be believed.
Why pensions matter and why we need to pay more attention to this subject going forward.
Thanks, Vikas, and thank you to Business Standard for having me here. Very, very briefly, let me just pick up where you left. The NPS is really the National Pension System, which came into through a notification in the Atal Bihari Vajpayee government, yes, and the act finally got passed only in 2015. Now, sorry, 13, and it really was meant for getting government out of a very sort of, difficult corner where government was only into defined benefit pensions, and it was clearly understood that this was fiscally completely, impossible to maintain going forward. And I think that was the brave decision, and therefore a concept of national pension system came in with a regulator's office, because the entire system was an unbundled architecture where you would have private sector pension funds dealing with the money of government subscribers who were mandated to whatever those percentages are. They've moved, but it's roughly now 10% of employee pension and 14% contribution from the government. So it's a pretty healthy contribution that comes as a co-contribution. This money gets invested in a mix of assets. The regulator's job was basically to ensure that the pension funds are sort of strike the right balance, probably the most difficult thing ever to do. But that was really the good decision taken, such that we moved to a defined contribution system. And that has been running exceedingly well, with that government kitty giving us a 9.2% year-on-year return over the last, I think, about 15 odd years. Now, that has really caused people to look at their accumulated corpus and feel pretty happy about it. On the heels of this was really making this available to the citizens of the country. But this never really happened, because I think it was too much of attention to the government pension and how to deal with that. And I think that's really where we stand today. Though it's been 20 years, but the ratio of the total AUM, which is roughly about 16 lakh crores, 16 trillion, is 75% government subscriber money and 25% others. This is the ratio that needs to be probably reversed. And that's really the challenge, I think, is what's before PFRDA, that can we make it 25% government subscribers and 75% the rest of the country, for which we have this huge challenge of creating a distribution network, or let me say, using the existing distribution networks that exist in the country. We've got a very well-developed financial sector, and it's for the pension funds to actually come in. And today there are 10 pension funds. There is a backbone of it's called a CRA, a Central Record Keeping Agency. So we have competition amongst them. It was earlier only one, now there are 3. But this interoperability between the CRAs is already established. So I would say we are sitting on a good architecture. We just have to exploit the natural or the animal spirits, if I may say, of the private sector to go out and get that business. And the business is not easy, because trying to tell somebody, let me now focus entirely on the informal sector, because people like you and me don't need too much of education, though I still think I'm illiterate. But the fact is that the informal sector is not very happy parting with money which they can't see. And they have no sight of what's going to happen 15 or 20 years from today. And that is really the biggest challenge, I think, that the distribution network faces, because this is not a mutual fund. And therefore, once again, sort of make that point very clear that mutual funds are used for a particular purpose. The pension fund is used for an entirely different purpose. And that is why the power of compounding has to be seen to be believed. So I was just telling Vikas that my own cook at home said NPS is all rubbish. I have no interest in it. And you have to actually sit him down with that pension calculator, which is there on the NPS Trust site, and show him that if I put 3,000 rupees every month for you for 20 years, we're saying 7.2 lakh rupees collected at the end of 20 years, you actually have a number that gets thrown up on the screen at 32 lakhs. It's a number that the poor fellow would never have dreamt of. But that is the kind of education that we need to provide. And in fact, it is probably even surprising to many of you sitting here that you can actually get 32 lakhs by contributing 7.2, but that is really over a 20-year period with the kind of returns that we have today. So, educating people about the fact that they need to grow rich before they grow old. And I think that's a lovely mantra which I've stolen from some speech of Nandan. But I think it's a wonderful way of telling people that this is why you need to invest and you cannot touch that money. So there are restrictions in the NPS system for you to withdraw money. It's a very difficult balance. We're actually going through several reforms. So, the reform is really directed to the non-government sector. And that's, I think, entirely what we're trying to do, is to make sure that if we have about 1 crore non-government subscribers today, we need to get that number up to, take your pick, but 25, 30 crores is, some respectable number, which we need to look at over the next 5 to 6 years. And it certainly is possible with the digital rails that are available, with the kind of, let me say, the databases that have got created over numerous financial institutions. So if I were to just look at SBI, they've got 45 crore bank accounts. Now, even if 1/10 of that gets converted to an NPS by just using the same KYC that already exists with the bank, it's just a press on a YONO screen for the guy to say, yes, I want to enter NPS. That is really how we need to go about creating that, sort of cascading effect or a multiplier effect, and making people realize that get into NPS and there's probably a much better future for you. So it's about, and just a comparison with what happens internationally. Most of the jurisdictions, pension is a mandated feature. If not mandated, it's certainly helped by tax incentives. Unfortunately, in the new tax regime, all the tax incentives that existed for NPS disappeared, and we have 70% people under the new tax regime. So, there is a bit of a challenge. I think the regulator really has to, do that little bit of extra work to ensure that we have that ability to bring the flows of money into the NPS. And again, internationally, the pension funds have funded infrastructure and funded startups. Now, that is really the productive way. I can see you smiling over here, but I think we have in a way, a moral duty to channelize that money to the productive sectors of the economy. And let's be honest, it's also a matter of giving the subscriber a better deal. So, we've just been reviewing the pension funds, and Suashish is here, and we've realized that money is just chasing those few 30, 40 stocks on the equity side. Now, we really have to diversify. And that's, I think, the other role that pension funds would have to play, is to go into areas which, because you are long-term, you can sustain the sort of, cycles within those particular industries. So I'm sorry you asked me to set context, but I've just gone way beyond that.
So that's a really helpful context setting, actually, because it also helps me get into my first question in a way. When you talked about global pension funds, having the kind of scale and diversification of assets, you said they fund startups, they fund critical infrastructure. I think anyone tracking financial markets for a while knows that when a fund like CalPERS or when the Ontario Teacher Pensions Fund starts investing in a stock, that stock is doing well and is bound to do better because they're getting long-term sticky money, not some overnight, capital that is going to come in and get out. So I think one is, of course, when can we expect Indian pension funds to achieve the kind of scale and size and intelligence in the investment strategy that CalPERS and the likes deploy? And secondly, can we also expect, maybe global expertise in pension fund management, the vanguards of the world and others, can we expect some of them to be allowed entry into, I know you are allowing private funds already, but can we
No,
expect some
but
of that?
I think that answer is already there because we are joined at the hip to the Insurance Act.
Right.
So if the Insurance Act allows 100%, equity for a pension fund, I mean, foreign equity for a pension fund, it'll, mutatis mutandis apply to pension funds. So we're completely clear about that. And I think the insurance bill is yet to get passed. So, that we were just waiting for that to happen. But there is an interest from foreign capital to come in. But I think the interest of foreign capital is more to get the returns from India, which is why you have all the, CDPQs of the world already over here, and they're making excellent returns out of India. So I would believe that for the Indian pension funds, we probably need to look at how to get more pension funds into the system. We are a very large country. I mean, I wouldn't be surprised if we have requests from people located, in tier 2 cities, probably tier 3 cities where there is a catchment area. You have large cooperatives, you have, areas where, there is a greater wealth, MSME clusters where there are large clusters with lots of people working in that. We never know where that demand comes from, and we need not also just stick to the existing structure of a pension fund. So, today it's a 50 crore capital that you need. Can we not look at having small pension funds if I were to take a leaf out of the small finance bank? So, you're dealing with a community, you're dealing with virtually no risk because the entire flow of money is on digital rails. And I think that is really where we need to leverage the fact that we've got the best payment system in the world. So why are we not able to bring in more people, have distributors who are probably not the regulated entities as we demand today? Because we just need to ensure that we are testing for the data flow in that particular system and ensure that there is a complete digital flow with no sort of, leaks anywhere there. So I think we should be certainly able to look at how the pension funds collect more money from within the country itself.
Right. That's very interesting. In fact, what you mentioned just before we entered that, even before Mutual Fund Sahi Hai campaign was launched, I think NPS Zaruri Hai campaign it predates the Amphi campaign. But somehow I think it needs a little more championship and, some evangelists to do this. Is there something that you have in mind now that you've got a sense of how PFRDA is doing things?
No, I think it's a great question. I think it's an issue that cuts across financial products. So I would really see financial literacy as the bulwark or the bedrock of a lot of buying of financial products. And we still need to get that literacy going in vast, amongst vast numbers in a lot of regions. So, we are so urban focused today that we've forgotten what it is, to be able to do a small business in a reasonably small town. And yet, I can assure you, having seen it during my SIDBI days, that there is such a high aspiration amongst those people to grow their wealth, to get their children better educated. So, we need to have financial planners. And that's really the point where I'm saying we have to cut across, the sort of turf between mutual fund, insurance, pension, have the large number of persons who are already there as a distribution workforce, ensure that we have a minimum certification program for each product which already exists with the likes of NISM doing an excellent job. And therefore, make that into a viable business. So a planner need not be, someone who's always in a suit, but who's there. I mean, I would even go to the extent of saying that the bank Sakhi is somebody who is so useful in the work that they are doing today amongst those, those set of people who have emerged from the self-help groups and today are so keen on improving their business prospects, because every household runs a bit of agriculture, runs business. You never know when the next person, improves their business prospects. So we really have to look at literacy going down to the grassroots. I think it's a huge area. And again, with the kind of digital rails that we've got, with the kind of reach of the mobile phone, a lot of content could just get targeted better to these particular people depending on who the user is. I mean, that's also happening. So I certainly believe that is something which the regulators should entirely do. I mean, it would be unfair to expect the pension funds to spend large money on that, but this is really where the regulators should be putting their effort behind this entire literacy campaign and to be able to reach the right audience with the right, content.
I think one thing that struck me is that, typically, as we all know in our personal lives and, professional lives also, that women are called better halves for a reason. There's a reason they are smarter about things. There is a reason insurance policies, advertisements now talk about women cursing their late husband for not getting a term insurance when he could have. So maybe pension could also look at, evangelizing first with women, because then they're the best effective transmitters of such information, and making sure that men get convinced of the need for a product. So that, John Maynard Keynes said that in the long run, we're all dead, but you need pension just in case you're not. So, but on a more serious note, I think the other regulatory issue I'd find in pensions is that in India, there's, apart from PFRDA and its, reason of existence being to, spread the pension culture, there is a dichotomy. I mean, there's a multipolarity in terms of pension products availability. I mean, if you look at it, the insurance industry offers a lot of these unit-linked insurance products, which have some kind of an annuity element. There are some other products which they claim will come handy for you when you turn 60. There are a couple of mutual fund products that are marketed as retirement benefit plans. There is also, of course, EPFO, which we talked about. And so is there a need, for instance, to have some cohesion in the way these products are viewed, regulated, maybe some dialogue with other regulators? I don't know.
Great question, and that dialogue is actually happening. So there is a regulatory forum for pensions which has already been instituted. But I think the larger issue is that we've had financial products emerge over the last, say 150 years, and each one has come in for a particular purpose, has served the purpose very well. So, we should not look at EPF as if it's anything inferior. It's brought a lot of money to a lot of people in this room. So we need to ensure that products are serving that particular purpose. So the pension part of EPF, which frankly nobody in this room probably even knows it exists, but there is a sliver that goes towards something called a pension, and suddenly when you retire, you have some 2,000 rupees coming to you and you don't know for what reason it's coming to you. But that is really where we need to strengthen the pension product, and therefore work has already started around that. But I would say that given the need of all these products, we need to have a simple definition which everybody adheres to. So in order to sort of reduce the possibility of mis-selling, what does a pension product mean? According to us, it is at least 15 years of being in a particular product and saving towards that. So we have something called a reasonable corpus that builds up. Again, the power of compounding, nothing else. But at the end of that, there is today the law says that you have to forcibly put it into an annuity. Now, an annuity is again a very good product. I mean, there's really nothing wrong, but given the fact that it has to deal with uncertainty of life, anyone who has designed that product will ensure that there is enough capital buffer, there is a solvency ratio that you ensure that you are in a position to meet the longevity risk as and when it happens. So, we have to provide alternatives in terms of the pension payout product. And that is, I think, what PFRDA has already, started. We've got a consultation paper out looking at the possibility of, with annuity, can we add something further? So one of the models is that you push an annuity to the age of 70 or 75. You have a sort of systematic unit redemption plan which runs for a period of time before that. But at some point, taking an annuity does make sense for some people. The others, in fact, one of the speakers in that conference said that, I'm sure, given my health, I'm not going to make it past 75, so why do I need an annuity? Let me have another way of, enjoying the wealth that I've accumulated. So I think the job really is for the regulator to put across a set of products that finally it is for each customer to choose what is suitable to him. And that is really what I think we are doing, and we have another innovative product in that sort of consultation paper is about, can we create a standardized pension credit such that through my working journey, I am accumulating pension credits, which I know will give me a particular fixed sum of money at the time I retire or for every year in the future. So we're talking about 100 rupees per month that a pension credit will give you 15 years from today. You may accumulate it through a conservative, moderate, aggressive, asset allocation. So that's really where the pension funds need to come together, understand that how do we create other products where we don't necessarily have to force people into annuities. It's one of the options. And does everybody want to take out money as a lump sum just because there's a tax advantage to it? So the tax bit also is very important. We need to understand that if there's a 60-40 tax ratio today, where 60% is tax-free and 40% is taxed, that 60-40 ratio could even apply to whatever income stream I'm getting as a pension payout product. So this is really what we're trying to work on, and understand that for the regulator to be seen as not only a regulator for the accumulation phase, but what we call as for the decumulation phase also.
I know, of course, some of these initiatives are intended at expanding the universe of people who will have some retirement security. But, it's a question that if Manish Sabharwal, my friend, would have been here, he would have asked me to ask you. And it's something that I think even Arun Jaitley alluded to, the late Arun Jaitley in one of his budget speeches said, can we work out a system where Indian employees have a choice between the EPFO and the NPS, and basically create a demonstration effect that makes sure that people are making better choices. Of course, that has not yet taken off, but even today we have young people who enter the workforce in the formal sector, as Mr. Sabharwal describes, hostages of the PFO. So is there I know you've got this new regulatory forum. I'm sure you're ironing out some things. Maybe you can tell us a little more about that. But can we envision a future, near future, where when I join a new job, my employer can give me an option between EPF and NPS coverage?
Once again, I'd just like to reiterate that EPF is a provident fund, which is an accumulation stage. Pension is both an accumulation and a pension payout stage. So the product is, let me say, different. The EPF, for good reason, because there was nothing else in this country, the pension sliver started in '95, and it's running Unfortunately, it was targeted to everybody and not just those below the threshold of income. So it's something which we, going forward, as part of the regulatory forum, we're talking about how these pension products could come under a single regulatory umbrella and therefore get, tied up together in some possible way. But I would say if you have something called EPF, you have something called PPF, these are, sort of, in a particular genre. So, let those products remain. It's for the understanding of the customers, given their tax profile, that what is those or what is that particular set of products that I should put my money in, which is best suited to me. So I think that's really where I would really look at how we move ahead with the concept of accumulation. EPF again has, I would say, a rate of return on its corpus, which is maybe a tad below what the NPS has got, but it's also a very good rate of return. So we should have competing products. I think that is really where we're moving forward. I mean, if EPF ends up putting its money tomorrow, say potentially through another set of funds, which could even be the pension funds, which could be other funds, it's really for the funds to make sure that they are giving reasonable return, and that level of competition really is what we should be looking forward to.